Hello and welcome to ESG Finance. Today, I'd like to talk to you about an article that is near and dear to my heart. Even God couldn't beat dollar cost averaging. So once upon a time, I was more of a single stock investor. I had a basket of stocks that I thought that would do well. And eventually I narrowed that strategy because typically you go with more of a narrow approach if you want to build wealth and a diversified approach if you want to maintain wealth. I was younger and I invested in one company. Then one day news article came out and boom, it lost half of its worth. So the stock went down by more than half. And all the money that I had been saving got cut in half. And so at that point, I was looking for a different strategy and I took a diversified approach so that I wouldn't be risking everything and wouldn't have the same thing happen again. And I came across this article, which demonstrates to you that day trading, or let's just say timing the market, is not exactly the best strategy because you're not perfect. You're not God, right? So what they do in this article is they have two different strategies here. The first one is dollar cost averaging. Every month you invest $100 for 40 years or buying the dip. So you save $100 each month and only buy when the market is in a dip. So obviously you know when these dips are. So this is backward looking. So let's say that you could time the market and you could time every single dip that happened. So your sequence of purchasing stocks was perfect. Well, what they found out was that about 70% of the time, dollar cost averaging beats buying the dip. So what implications does this have for your stock portfolio? Well, it's all about time in the market instead of timing the market. That's the point of this article. And I would suggest that you do the same, that you just dollar cost average into a diversified approach. So the reason why this works, let's look up the S&P 500. And if you guys are not familiar with the S&P 500, it is a portfolio of stocks that is managed by an overseeing governing body. And it's the top 500 stocks that this overseeing body thinks that are the top 500 stocks in America. And what you can see with this timeline, so you're going way back to like 1982, but if you went back even further, the stock market was not higher, it was lower. So over time, everything goes up. So that's how this works. The dollar cost averaging works. It's the fact that you could buy the dips, but every time you buy, the dip is even more expensive than the dip previous to it. So that's why buying the dip does not work, because over time, if you wait, the market runs away from you. This is largely how I built my portfolio wealth, was to dollar cost average into the S&P 500. After I made my huge mistake, I had an adventure and attempted to beat the market by choosing the winners, the single stocks. I switched to this strategy, purchasing the S&P 500 and dollar cost averaging into it. And you should consider doing the same. If you enjoy this video, please leave a like and subscribe, and I'll see you on the next one.